Have you ever wondered why so many algorithmic trading systems look great until they suddenly blow up? The missing piece is almost always risk structure. So in this video, I'm going to show you exactly what happens when risk isn't built in and how you can make sure your algo survives real markets and not just back tests. So in material science, the most dangerous failures don't come from constant pressure. They come from what's called stress cycles, repeated loading and unloading that creates microscopic fractures over time. Everything looks fine until suddenly the structure fails, everything blows up. And trading systems kind of behave the same way. They survive hundreds of small shocks, thousands of trades, and years of normal conditions. Then one extreme sequence appears and the accumulated fragility is exposed all at once. The problem isn't bad luck, it's that the system was never designed to handle the stress that it was inevitably always going to face. So with that in mind, let's walk through the core principles that should sit underneath any robust trading system. Firstly, markets are not predictable. Markets are often described as volatile, as if volatility were a problem to be solved. In reality, volatility is the defining characteristics of a free market, especially in Bitcoin. Price does not move in smooth, forecastable trends, it actually moves in bursts, in regime shifts, in long compressions followed by sudden expansions, and rare but violent tail events. So from a first principle standpoint, this is not a defect in the market, it actually is the market. And any system that requires accurate and repeated directional prediction is therefore fragile by design because it is exposed precisely where markets are least cooperative. A robust framework does not try to eliminate volatility, it accepts the volatility as inevitable and asks a more durable question like, how should capital behave in an environment where uncertainty is permanent? Once volatility is treated as a constant rather than an anomaly, the entire problem of the system design changes. And the next one is that scaling must be defensive. So one of the most dangerous failure modes in trading systems comes from aggressive scaling. Many approaches increase position size as price moves against them in what's called a martingale strategy. Now this logic is often dressed up as risk management, but structurally a martingale is very, very different. The martingale problem is well understood outside of trading. In roulette, for example, doubling down after every loss works perfectly until it doesn't, because getting 20 red spins in a row is unlikely, but it is absolutely possible. And when it happens, the strategy doesn't fail, it fails completely. And there are countless reviews of algorithmic services that look impressive on paper only to end the same way. Accounts that worked until they didn't, followed by sudden total blow-ups. One recent review put it bluntly, describing a system that relied on martingale-style scaling and often blows accounts up despite strong back-tested performance. So a defensively designed scaling framework does the opposite of a martingale strategy. Additional exposure exists to absorb reverse movements, not to chase profits. And position sizing is constrained, scaling is pre-planned, and exposure increases only within a structure designed to survive extreme outcomes, and it doesn't do it only until the account completely just blows up like martingale. Position sizing is constrained, scaling is pre-planned, and exposure increases only within a structure designed to survive extreme outcomes, unlike the infinite scaling required in a martingale system. Next is risk must be finite and predefined. A system is only robust if its risk is bounded before the trade begins. The maximum adverse move the system is designed to tolerate is also defined, and there is a clear boundary where defensive behavior stops. This eliminates the most dangerous form of fragility, and it's called open-ended exposure. There is no infinite scaling, no doubling logic, and no assumption that time alone will fix a bad position. Losses are possible, but they are engineered and they are not accidental. From a theoretical standpoint, this is what separates survivable systems from absolutely catastrophic ones. And at this point, the question becomes how to anchor those risk boundaries to something structural rather than arbitrary. So one approach is to use long-term statistical frameworks developed outside of traditional technical analysis. And this is where the power law framework comes in. And this work was developed by a PhD physicist named Giovanni Santastasi, and it models Bitcoin's long-term behavior on a logarithmic scale. Within that framework, the lower power law region, its support, functions as a statistical reference point rather than a prediction. It is not treated as inviolable or guaranteed actually by us. Instead, it acts as what we call the first line of defense, a zone where risk management decisions begin, not where certainty is assumed. So even here, the system is designed to respect the possibility of further downside because robustness comes from preparation and not from belief. And the next one is exits should be paid by volatility, not not correctness. So just as entries should not depend on being right, exits should not depend on forecasts coming true. So systems that require new highs, perfect trend continuation, or narrative validation to exit profitably are implicitly brittle. A more durable approach treats volatility itself as the source of returns. So periods of compression are not problems to endure, they are setups to expansion. Exits triggered on strength, often through trailing mechanisms, allow a system to be paid for movement rather than prediction. And this has two critical effects. First, it allows profitable exits even in sideways or range-bound environments. It also doesn't rely on mean reversion, and it also regularly resets exposure, preventing capital from being anchored indefinitely to a single thesis. So over time, this dramatically reduces tail risk. So these principles aren't ideas that only work on whiteboards or in backtests. They're constraints that matter most when the numbers are large and the margin for error completely disappears. And that's why I recorded a separate video walking through a live position size of $1.2 million, not as a highlight reel and not to impress anyone, but to show how these principles actually look when real capital is on the line. So seven-figure trading isn't about being more aggressive or more confident, it's about being more constrained. And the bigger the capital, the less room there is for improvisation.